Welcome to the Deep Dive. We're here to help you go beyond the surface level and really get informed about investing.
Especially if you're aiming for, better than average results as an enterprising investor.
Exactly. And today we're digging into a real classic, Benjamin Graham's chapter on portfolio policy for that enterprising investor. It's chapter 7 from The Intelligent Investor.
Yeah, a foundational text. Now, keep in mind, it was written around 72 based on decades of his experience. So some examples are from back then.
Right. Think of it like looking at old architectural plans. The specific light fixtures might be dated, sure, but the structural principles, they still hold up.
Absolutely.
Our mission isn't just to summarize. It's to pull out the key insights for you, the listener, aiming to actively find opportunities.
So what were those specific paths Graham laid out? The ways an investor willing to do the work could potentially, beat the averages. Let's jump in.
Okay, let's start with something everyone thinks about. Just buy low, sell high. Simple, right?
Sounds simple. And Graham, well, he definitely got the appeal. But he was actually pretty skeptical, especially after about 1949.
Oh, why then?
He felt that trying to consistently time the market using formulas based on charts, it just wasn't reliable anymore. The market's ups and downs post 49, they didn't really fit neat mathematical patterns you could easily trade on.
Huh. So no magic formula for market timing. He does mention the 50-50 stock bond thing for the defensive investor.
Right, as a contrast. But for the enterprising one, the one we're talking about, he gave much more leeway, like 25% to 75% in stocks, depending on how strongly you felt about the market.
Okay, but if broad market timing is out, where does the enterprising investor look?
Well, that brings us right to growth stocks. Companies expected to grow earnings faster than average. Super appealing idea.
Definitely. Who wouldn't want to find the next big success story early? But Graham, he throws some cold water on that excitement, doesn't he?
He does, a big dose of caution. His main point was, look, the high prices these stocks often trade at, they already reflect those rosy future hopes.
So even if the company does grow, like expected.
Your return might be just... Okay. Because you paid so much up front. Plus, he pointed out, past fast growth doesn't guarantee future fast growth. Especially as companies get bigger, it's just harder to keep up that pace.
He backed this up with data too, right? There was a study of growth funds, 1961 to 1970.
Yeah, exactly. And what's really interesting is over that whole decade, the average gain for those growth funds was about 108%.
Sounds decent.
Well, compared to the S&P 500 at 105% and the Dow at 83%, it's not exactly stellar outperformance,
Right. Barely better than the S&P.
And get this. In 69 and 70, the last 2 years of the study, most of those funds actually underperformed the market indices.
Wow. So even the pros focused on growth struggled to beat the market consistently. That really makes you think.
It does.
And he had specific warnings about price-to-earnings ratios, the PE. Like, be wary of anything over 20.
Yeah, that was a general guideline. And for the defensive investor, he suggested not paying more than 25 times the average earnings over the past 7 years.
Why so cautious about high PEs?
Because, he argued, there's often a big speculative element baked into those prices. Market enthusiasm can just run away, pushing the stock price way ahead of actual earnings growth.
You see that sometimes, right? A stock gets tons of hype, everyone's talking about it.
And you wonder if the easy money's already been made. Graham also touched on those stories of people making fortunes on one growth stock.
Yeah, the legendary wins.
But his observation was often those huge gains went to people really close to the company founders, insiders, people with deep knowledge and conviction to hold through the crazy ups and downs.
Not the average investor.
Exactly. For an outsider, putting a big chunk of money in one volatile growth stock and trying to ride it out, it's tough. The urge to sell when things get rocky is strong.
Okay, so Graham's cautious on market timing, cautious on typical high PE growth stocks. Where does he say the enterprising investor should focus? He had 3 main areas, I think.
He did, yeah. 3 specific fields, and the criteria were key. 1, the strategy had to be, objectively sound, based on logic. And 2, it had to be different from what most other investors or speculators were doing. Going against the crowd, essentially.
It makes sense. Let's take the first one. The relatively unpopular large company, what's the logic there?
The thinking is, if the market tends to overpay for the glamorous, exciting stocks,
it might be undervaluing the solid big companies that are just maybe a bit boring or going through a tough patch temporarily.
Precisely. The market kind of overlooks them while chasing the next shiny object.
And why large companies specifically?
Well, Typically, they have the resources, the money, the management to recover from problems. And also, when things do start to improve for a big, well-known company, the market often notices and reacts more quickly.
He brought in some history here, too, looking at the Dow Jones stocks.
Yes, and it's fascinating. He studied a strategy every year, invest in the, say, 6 or 10 stocks in the Dow with the lowest PE ratios, the cheapest, most unpopular ones.
And how did that work out?
After a rough patch earlier on, like 1917 to 1933, it actually worked surprisingly well from 1933 onwards.
And there's another study, Drexel and Company.
Right. They looked at one-year periods from 1937 to 1969 and found that those cheap, low PE Dow stocks beat the overall Dow average in 25 out of 34 years. Pretty significant.
Wow.
He even gave an example. $10,000 invested in those low PE stocks back in, I think, 36, rebalanced yearly, would have grown way more by 62 than investing in high PE stocks or just the whole Dow index.
That's compelling. But he did add a warning, right, using Chrysler as an example.
Yes, a crucial one. Companies with really cyclical earnings can look cheap on a PE basis in a great year just because earnings are temporarily sky high.
Or look expensive in a bad year, even if the stock price is low.
Exactly. So Graham stressed you can't just look at the current PE. You need to consider the average earnings over time to avoid those weird situations. Chrysler's wild swings in price and earnings showed that risk clearly.
And he noted this low PE Dow strategy didn't work so well right at the end of 1968.
Right. A reminder it's not foolproof. The test then showed a loss. So Graham suggested maybe using the low PE as a starting point, but then adding other checks, other criteria, not just buying automatically.
Okay, good context. Let's move to the second area, buying bargain issues. How did he define a bargain?
Pretty clearly. It's a stock where your analysis tells you its actual value is, say, at least 50% more than what it's selling for in the market.
50%, that's a big gap.
It is. It's about finding significant undervaluation. And this could apply to bonds or preferred stocks too, but mainly common stocks in this context.
How do you spot these bargains? What methods did he suggest?
2 main ways. First, appraisal. Try to estimate future earnings, apply a reasonable multiplier or PE, and see if that estimated value is way above the current price.
Okay, forecasting involved there.
Yes. The second way is looking at it like a private owner would, focusing on the company's assets, especially what you could realistically sell them for. Net current assets or working capital was a big focus here.
And he said these pop up more often in market downturns, like GM in 1941.
Definitely. When everyone's panicking, even good companies get thrown out cheap. But he also said bargains can appear anytime, just due to, temporary problems or the market simply ignoring a company for a long time.
But again, a warning.
Yeah.
Don't just jump on a stock because results are bad now. He mentioned Anaconda Wire and Cable.
Right. Just because a company's down doesn't mean it's a bargain. He stressed looking for companies with a decent history of stable earnings, enough size and financial strength to ride out storms. Ideally, a big company selling below its average historical price and PE.
What about that protracted neglect idea, where the market just ignores a company?
Yeah, he gave examples. National Presto Industries in the late 60s, early 70s, earnings were growing. It was near its net asset value, but the stock was still cheap, low PE.
Overlooked.
Seems like it. Another was Standard Oil of California around 72. Price was basically flat for 13 years, even though earnings were solid and the PE was low. Market just wasn't excited about it.
And sometimes the market just doesn't see the real earnings, like Northern Pacific Railway back in the 40s.
Exactly. Their accounting and low dividends kind of hid the true earning power. So digging into the numbers could uncover value the market missed.
But the ultimate bargain, the classic one he mentioned, selling for less than net working capital. That sounds wild.
It does. Basically, you deduct all debts and liabilities, and if the stock price is still less than the remaining current assets, cash, receivables, inventory, you're essentially getting the factories, equipment, brand name, everything else for free.
Does that even happen?
It's rare, but yes. He's cited a study from 1957 that found about 150 such stocks, and buying a group of them produced really good results over the next couple of years. Way better than the market.
What were the returns like?
Something like a 75% gain versus 50% for the S&P index at the time. Pretty impressive. He noted these became rarer after 57, but did pop up again in the 69-70 downturn.
Fascinating. Okay, third area. The bargain issue pattern in secondary companies. First off, what are secondary companies?
Basically, companies that aren't the big leaders in major industries. Maybe smaller players or leaders in less important sectors. If a company was seen as a high-growth stock, It wouldn't really fit this category.
And why look for bargains here?
Well, historically, especially after the Depression, investors really favored the big, safe-seeming market leaders, which often meant these secondary companies got ignored, undervalued, even if they were perfectly solid businesses. The market worried about their future, maybe unfairly.
But sentiment changed over time,
Right.
Sometimes they were undervalued, sometimes overvalued.
Exactly. Market moods swing. After WWII, smaller companies did really well for a bit, maybe got overvalued. Later, you saw waves of excitement for like electronics or computer stocks, again, potentially leading to neglecting other solid secondary firms. These cycles create opportunities.
So why can buying these undervalued secondary companies be profitable? What makes them work out?
Graham listed several reasons. They might offer a higher dividend yield. Their reinvested earnings can have a bigger impact because the stock price is low. Bull markets tend to lift these lower price stocks significantly. Market prices adjust over time. Maybe the specific problem holding them back gets fixed. Or they become takeover targets for bigger companies, often at a nice premium.
Makes sense. He also briefly mentioned bargains in bonds and preferreds, and even defaulted railroad bonds for experts.
Yeah, just broadening the idea. Wherever you can find assets selling for significantly less than their real worth through careful analysis, that's where the enterprising investor looks. The specific opportunities change, but the principle stays the same.
Got it. And the last category was special situations or workouts. What's that about?
These are more event-driven things, like when one company buys another, there are often price discrepancies or arbitrage opportunities. Or think about bankruptcies and reorganizations, especially complex ones like old railroad cases, or when big holding companies were forced to break up.
What's the common thread?
Usually there's some kind of legal or financial complexity involved, and the general market tends to get scared off by complexity, which can lead to the securities involved being temporarily undervalued.
But he cautioned this is pretty specialized, right?
Oh, yeah. Definitely requires specific knowledge, skills, a lot of research, probably only suitable for a small number of really dedicated enterprising investors. Not for everyone.
Okay, so those are the specific hunting grounds. Then Graham kind of zooms out, talks about the bigger picture, the investment rules. He really hammers home that choice, defensive or enterprising.
Absolutely. He's very clear. Being an enterprising investor isn't a hobby. It takes serious knowledge, serious effort. You have to treat it like a business. And he strongly advised against trying to be somewhere in the middle.
Why not?
He felt that kind of halfway approach often leads to disappointment. Better to commit fully to one path or the other. Most people, he thought, should probably stick to the defensive approach.
And he circled back to certain types of securities. Foreign bonds, preferred stocks, secondary common stock, saying defensive investors should usually avoid them at normal prices. What about enterprising investors?
They can buy them, but only if they're true bargains. His rule of thumb was, don't pay more than 2/3 of what you calculate their real value to be. That margin of safety is critical for these riskier areas.
He raised an interesting point. What if everyone followed that advice about secondary stocks? Wouldn't they just always be cheap?
It's a bit of a paradox, yeah. If everyone demands a huge discount, maybe prices stay low. But Graham's experience told him that you generally only make good money on secondary stocks if you do buy them at a bargain price, like less than what a private owner would value the whole business at.
Because they lack the stability of the leaders.
Right. They might have growth potential, maybe even similar to a leader, but they often come with less stability, less predictability. So you need that price discount as compensation.
And he made a distinction between outside investors and insiders in these companies.
A very important one. Insiders, people running the company, they have deep knowledge. They can buy shares like owning a private business. But us outsiders, we lack that intimate view. So we need that margin of safety, that bargain price. Good management-shareholder relations are also extra important here.
Okay, that covers Graham's core ideas pretty well. But then Jason Zweig adds his commentary in the modern editions, which is super valuable. One of his first points is, don't trust yourself too much.
Such a critical reminder. Zweig really emphasizes that everyone makes mistakes. That's why Graham always pushed for diversification and never putting everything in stocks. You need that cushion in case you're wrong.
And Zweig suggests the pretend portfolio idea. Tracking picks for a year before using real money. I love that.
It's brilliant, isn't it? A totally risk-free way to test your ideas, see what works, what doesn't, and crucially understand why things happen the way they did, without the emotion of real money on the line. Zweig says use a checklist, compare against benchmarks, really treat it seriously.
Zweig also talks about Graham's later thinking, this group approach, almost like smart beta today, focusing on simple criteria.
Yeah, later in his career, Graham leaned more towards buying baskets of stocks that met simple quantitative tests, things related to debt levels, dividend yield compared to bonds, earnings yield compared to bonds, less deep dives into individual companies,
Easier to implement, maybe.
potentially. Zweig even updates Graham's old criteria with numbers that might make sense today, giving people a starting point for that kind of factor investing.
He mentioned the Regram Fund, too, and some lessons learned there.
Right. It had early success but then faded a bit. The lessons are important. Stick to your rules consistently. Don't, for instance, sell winners too soon just because they hit a target. Be aware of the big picture, like how inflation affects bonds if you hold those. Consistency is key.
Zweig's idea of keeping a watch list with target buy prices also seems really practical for fighting emotional decisions.
Definitely. Decide your price based on value before the market goes crazy. It helps you buy when prices are low and fear is high, instead of chasing stocks upward. But, he stresses, you still need to keep monitoring the companies on that list, make sure the fundamentals haven't deteriorated.
And lastly, that powerful idea of memorializing mistakes, like the mistake wall at Davis Advisors.
Yeah, I think that's fantastic. It's not about beating yourself up, but about systematically learning from what went wrong. Why did you buy that stock? Why did you sell that one? Why did you pass on an opportunity that worked out?
Looking at the process, not just the outcome.
Exactly. Zweig suggests tracking not just what you own, but what you sold, and even what you thought about buying but didn't. It helps uncover your biases, your blind spots, so you don't repeat the same errors.
So wrapping this up for our listeners aiming to be enterprising investors, what are the big takeaways from Graham, updated by Zweig?
I think it's really about moving beyond speculation, beyond trying to time the market or just buying hot growth stocks. It's about a rational, disciplined, research-driven approach.
Finding value where others aren't looking.
Precisely. In those unpopular large companies, in genuine bargain issues, maybe even those selling below working capital, or in neglected secondary companies. And Zweig adds that crucial layer. Test your ideas rigorously, be humble, and learn actively from your mistakes. Mistakes will happen.
It really drives home that being enterprising takes work, takes a willingness to maybe go against the grain, and definitely requires constant learning.
Couldn't agree more.
So maybe take a second now to think about your own approach. Are you truly operating like Graham's enterprising investor? Here's something to chew on this week. What's one concrete thing you could do to start applying these ideas? Maybe start that pretend portfolio, or begin researching some potentially unpopular large caps.
Look, becoming a successful enterprising investor isn't instant. It's a journey. But by applying these kinds of principles, thinking critically, and learning as you go, you really do improve your odds of getting those better than average results over the long haul.